What is up? So you are wondering if you should use a Heloc versus a traditional mortgage. Well, in this video, I'm going to show you an easy way to do the analysis yourself to see which one would best fit your needs. Now, in the example that I'm going to give, I'm going to do it with the goal of paying down my debt as quickly as possible because I think that is a smart move to do. And if you like to pay down your debt, if you'd like to be debt-free, do me a favor and smash the like button on this video. All right, and if you found this video and you have no idea what the heck a Heloc is, it is a home equity line of credit. And I'm gonna break down the differences between the two. Now, a traditional mortgage, that is pretty simple. It can either be a 30-year or 15-year. There's a bunch of different terms, but you can have a traditional mortgage with a fixed rate, meaning your interest rate will always stay the same. The term can be a number of different years, and you're gonna have a payment that is going to be paying down the principal plus interest on that throughout your term. Now, a few differences between that and a Heloc is a traditional mortgage, the money that you've paid in is not liquid. You cannot easily pull that out. You would have to completely refinance your house. So it is not liquid. And it is awesome with the fact that you get to have a lower interest rate than a Heloc. All right, a home equity line of credit. So this one is a little bit different than a traditional. Typically, you will have some type of a term, say it'd be 10 years, where you will be making interest-only payments, so you actually don't have to pay down on the principal on it. You're actually borrowing money off of the equity in your house, just like you would on a traditional mortgage. You're borrowing money with that house as collateral. Now, a few differences. The money that you pay into a Heloc, so if you were actually able to pay some of the principal down, you could actually pull that money out anytime you want. So it is liquid, whereas a traditional mortgage is not liquid. One big difference though is the interest rate. You may have a little bit higher of an interest rate for a home equity line of credit, and that interest rate could be variable, meaning it could change depending on what the Federal Reserve does. Now with a Heloc, because it is a 10-year term or you're paying only interest on it, at the end of that 10 years, you will either have a balloon payment, meaning you would have to pay back the entire principal balance of that, or some of them will automatically convert to a 20-year fixed rate mortgage at that point in time. And you could also just get to the point when you've reached the end of your interest only payment and you could refinance and you could pay it off and go back to a traditional mortgage or renew a new Heloc if you'd want to go that route as well. All right, now let's jump in. So I'm gonna show you on Excel how to go in and compare a traditional mortgage and a Heloc mortgage. But if you could do me a favor before we jump into that, help me hit 100,000 subscribers by hitting that subscribe button right now. All right, so let's bust it out in Excel. So right now I have the traditional mortgage up and my assumptions are I have a loan amount of $175,000 with a 3% interest rate over a 30-year term. Now I also have $20,000 in savings right now for an emergency fund. So those are the assumptions that I'm running with. Obviously you can put in your own numbers to do your own analysis. What I'm going to do is say I have $1,000 to pay down on my mortgage. So I'm going to run the numbers with the traditional, and then I'm going to take those same assumptions and run it with my Heloc, which I will do in just a second. So if I have $1,000 to pay down this mortgage, if you can see right here, I have a total payment of $737. So my extra payment will be $262.19. That'll get my total payment to $1,000. Now, what I'm going to do is I'm going to compare the total interest paid and then the actual number of payments to the same thing that I do for the Heloc to see which one helps me save the most money on interest and pay down my debt quicker. And one thing that I like to do is I like to just take the actual number of payments and I like to divide it by 12 because that way it'll put it into years. So if I just pay that extra $262 a month on this mortgage, then I will pay off my mortgage in 19.25 years. And the total interest that I pay on this loan is $55,000. So now let's jump over to the Heloc one. Now the Heloc, like I said before, I have $20,000 in savings. So what I would suggest, because savings rates are just ridiculously low right now, you just don't get paid very much interest, it is far better to have your savings on this Heloc and be able to pay down that mortgage. Now I wouldn't suggest it on a traditional mortgage because a traditional mortgage, that money is not liquid. If you pay down that mortgage, you're not going to be able to pull that out very easily. You'd have to do a cash out refinance, and that's expensive. But with a HELOC, it's a line of credit. So any money that you put into it, you can just pull it back out the next day. So that $20,000, it would still be liquid. You still have access to it, but you can have it pay down your mortgage. Now, a HELOC, like I've said before, has a little bit higher of an interest rate. So I took the same $175,000 loan balance. I decreased it by my savings because I'm going to put all of that right there, because it's better for me to pay down a loan that has 3.5% interest than leave it in a savings account and have it make like 0.01% interest. So that's why I put there. So I have a $155,000 loan balance. I have a little bit of a higher interest rate at 3.5%. Now I just leave it at 30 years because with a HELOC, it's going to be more of like a 10-year term. It's going to be interest only. But with this loan amortization schedule, it's not calculating interest only. It's going to be as if you're paying principal, which I'm going to do anyways. I'm going to have a payment of $1,000 regardless of whether or not it's just interest only or principal. Right now I'm paying $1,000, so a lot of it is going to go to principal. Now to get it to $1,000, I did the math previously, so I'm going to pay an extra $303.98 each month to have a total payment of $1,000. Now you'll see in the HELOC, my actual number of payments is 207. Now, if I divide that by 12, it's 17.25 years, and I'm paying a total interest of $51,000. If I compare that to the traditional, I'm paying it off 2 years quicker with the HELOC, and I'm saving $4,000 or so in interest. Now, obviously, all of this can change based upon the assumptions that you have. Also, a thing to remember is with that HELOC, you're putting your savings account in it because it's better to pay down that interest. And that's how people make these HELOCs work for them, is they put money in it and it'll pay down that loan. Now that money is still liquid, so you can still pull it out if you ever do have an emergency. But one thing to know is when you're going to close that loan, if you've paid that loan down and you want to just completely close it, you're going to have to save back up that emergency savings, or you're going to have to pull it out and then you'll have to pay down. So this could end up making the HELOC similar to that traditional mortgage as far as total time to pay off if you are having to pull that savings account out. But there are ways to make your HELOC pay down your debt quicker and make it a really useful tool. Okay, so in this example, the HELOC actually pays down the debt quicker, but just like I explained, there's different variables that go into it. You may have less money in an emergency savings that you could put down on your HELOC, and that's why I wanted to show you how you can do this analysis all on your own. There are also ways that you can actually make the HELOC work even better for you, and that's by temporarily paying it down while you're waiting for something to come due. For example, if you have a credit card payment and you're paying it every single month, because you should be paying that thing off every single month and not running a balance on it. But say you have a $2,000 credit card payment that's due at the 15th of every month, you can take the money that you would use to pay that down and just put it down on your HELOC for that entire month until you get to that point where you have to pay your credit card. Pull it off of the HELOC and put it on there. That way your average balance for your HELOC is a lot lower and you save the money on interest. Now, one overarching risk that I see with HELOCs is interest rates. Because they're floating, you never know exactly where your interest rate is going to land. Now, right now, interest rates are crazy, crazy low. So you can actually get a HELOC with really, really low interest rates. But the Federal Reserve has signaled that there could be rate hikes in 2022. So that means if you have a HELOC, your interest rate has the risk of going up. Whereas if you locked in a traditional mortgage right now, your rate would be locked at a really low interest rate. I actually have some people that I know that use HELOCs exclusively because they feel like, because of the things that I mentioned where you can put your emergency savings in it, and you can have that money paying it down. Even by floating your credit card payment, you have that on your HELOC until you're ready to go pay it. You are running a lower principal balance, and even though you have a little bit of a higher interest rate, you still aren't being charged as much interest, and you can pay off your mortgage quicker. Now, if you have any tips, if you're doing this yourself, please hit me up in the comment section. I would love to learn what you are doing to see if you can really make this a heck of a lot better than just having a traditional mortgage. All right, thanks for watching. If you would like to check out another video on whether or not you should refinance, I'm going to put it right up here. We'll catch you guys next time.